Yeah, ready to go?
All right.
So we finally have some updated information on the OSFI rules. So I know that there's been a ton of misinformation out there. I think a lot of people are kind of drawing their own conclusions, and it's causing a lot of confusion. So I finally, from some of the lenders, have started to get what's going to happen before and after. So it looks like, as it stands now, as long as you have an application or an offer signed before December 31st, it doesn't have to be submitted to the lender beforehand, but it just has to be signed before December 31st. They'll honor it whenever it closes, whether it be a new construction that closes in 4 or 5 years or closing in March of 2018. So I think that is, there was a lot of uncertainty on how that was going to work. Same thing with refinance applications. If they're submitted prior to December 31st, those have to close within 120 days to have the terms honored. It's a pretty significant change. I think, when it comes down, it's going to have a bigger impact than people think. So if you have a family that make like $150,000 a year, let's say, if they had 20% down, they would have previously qualified for a mortgage of about $850. And with the new rules, having to qualify at the posted rate, so basically qualifying 2% higher, takes that pre-approval down to like 660, 670. So it's a pretty significant change. Yeah. So I think that, just looking at my clients, I'd probably say 3 out of every 4 go, pretty close to what they qualify for, to the maximum. So I think the potential for it to be there is pretty great. I've also found, both through my business and just reading some statistics, that almost 80% of the transactions are now conventional buyers. So the CMH, so people that have 20% down, so it will impact 80% of, potentially the market. The CMHC rule, yes, David?
So that 20% down then turns out to be, it worked out 30% down.
It makes it much more difficult to qualify, for sure. It's going to really impact the...
No, that guy that had 20% down to buy $800,000.
Now he needs to put more down?
No, that 20% that he had, like $200,000. Now
Yeah.
we buy something 660.
Yeah.
It's like 30%.
Yeah.
Got a bigger down payment.
I feel like there's potential that, when we had that first CMHC change at the start of the year, it put pressure, dropped people from, let's say, that we're looking at $1 million down to like 8, the 8s or the 7s. Yeah.
Okay, then by doing that spread, he can go back to 20% down
Yeah.
to 660.
Yeah.
But he's got extra money. He can buy 710.
I think what you'll see is there will be more pressure in that like 550 to 850 market. I think the reality is, I don't know if it puts more pressure on the condo market.
What about second mortgages?
They are available.
Was that going to affect?
Well, the thing is, those second mortgages and alternative lenders are not regulated. OSFI is basically regulates bank lenders and anyone that gets their funding from banks, so any mortgage companies. So alternative type lenders, the reality is that space will probably see a bit of a growth, which means increased carrying costs. So people could expect to pay 3 to 4% higher.
Yeah, on the second part.
Yeah.
On 200,000, it's not bad. It's still high.
No, but you have to qualify if you're going with a bank regardless, right? And you'll have to qualify for the mortgage payment on that second mortgage as well. So it's going to impact your qualification, right? So you may just have people going to private lenders or alternative lenders for the entire mortgage, which means, adding, $1,000, $1,500 a month in carrying cost on like a...
Which defeats the purpose of trying to get down the debt.
Exactly.
Would it be that much more to go through, like I'm with Duca, like my mortgage is with Duca, so at the time, I think, it was like 2.89 and I think we qualified at 3.29, so.
The alternative lenders are in like so for example, say a 5-year fixed rate is close to like 3% today. Alternative lenders might be like 5.5%, somewhere in that range. And then private lenders usually start at around 7, 8%. So yeah, there's fees on top of that, right? So the impact could be pretty great. It could be pretty substantial. I think, it'll take a few months to kind of get a great idea of how it's going to play out. But people think that if they get a pre-approval locked in prior to December 31st, that it will be honored. You have to have a purchase agreement signed before December 31st. So it doesn't matter what the bank gave you before. You'll be qualifying under the new rules as of January 1st.
So self-employed people are really screwed now.
Yeah.
Self-employed people have had a hard time for the last couple of years. Yeah, we're seeing that self-employed people, unless you've got 35% down payment, you're looking at alternative lenders. We used to be able to get those done with banks.
35 normally saying?
For self-employed.
35%, yeah. There are a few programs for self-employed borrowers where you can go through CMHC, but you pay a pretty substantial CMHC premium to do it. I think the CMHC premium with 10% down is like 7%. So 7% of the mortgage is added into the loan for a CMHC self-employed program. They have very narrow parameters as well. They want to look at your gross and then your net, and if there's a huge spread between the two, they're not accepting it. They're making those deals very, very difficult to qualify.
Maybe we'll start to see a comeback of BTVs.
Potentially.
What's that acronym?
Vendor take back.
Oh,
So the vendor holds.
The seller would basically give a second mortgage back. Yeah.
Yeah. Those would always be a second mortgage, obviously.
Or sometimes they'll do a first as well. Yeah.
Yeah.
Uh,
A partial exposure.
Potentially, yeah. I see those on commercial deals quite a bit as well.
In the resale market, it's not been coming.
No.
It's been around.
The other thing we might start to see again are people assuming mortgages. If someone locked in at a great rate, and that, yeah.
Are we gonna have to start bringing like the Oklahoma clause back into our paperwork
What's the
It's
Oklahoma?
always
clause?
there.
for the second mortgages?
I don't know what that is.
Second mortgage can't be more than the value of the property.
Oh, I never knew that was in.
Tax the
Oh,
second
okay.
mortgage, they can't-
Well, no bank will allow you to finance over 100%, even if they're only financing a certain percentage of it. Usually, if you're getting a second mortgage, the banks want to see that you have at least like 5 to 10% of your own money in. So
I learned that in class.
Yeah.
I never knew that was a term.
That's where I heard it from all the time.
So I think, yeah,
I think all of us have a perception that this is going to affect the market.
Yeah.
And in talking to most people, the buyers and the public at large doesn't seem to be as concerned about this as we are.
I think they should be just based on what I'm looking at as far as how many people go towards the high end of their budget, right?
It just seems there's been so much government interference, but this is the first thing that nobody seems to pay attention
No.
I don't think they understand.
No. We've been waiting for some clarification as well. Like, did you have to, what were the rules going to be for people that were buying new constructions closing, 3 or 4 years from now? Every time there's been a rule change in the past, everyone's been grandfathered in. And that was the expectation. So getting some clarification like yesterday was actually, it allows us to plan a little bit better. So you don't have to worry about making sure anything's submitted, just making sure that the offer is signed prior to the 31st of December. Some lenders may have different policies, but most of the lenders will have similar policies. So,
It's less than 2 months.
yeah, it's happening.
The sellers I've been talking to are worried about price cuts.
Yeah, for sure.
Serious,
should be.
serious price
Yeah.
cuts. Yeah.
Absolutely.
And it's gonna happen, so.
Everyone's wondering if they should rush to get their houses listed right now, right? So, yeah. I think that it'll have a greater impact than people are. I think it's being a little bit, people are underestimating the impact that potentially could come from. Yeah, yeah, absolutely. I've noticed a pickup for sure. Yeah.
Could I ask you to go back over, I missed what you were saying in the beginning, so if you could go back over, what exactly is going to happen in January? I know
Sure.
around it, but I
Sure.
don't know.
So currently, if you're a borrower that's putting less than 20% down, the bank at January 1st of last year put a stress test in place, which meant you don't qualify at the face rate you're paying. You're qualifying at a posted rate, which the government sets, which is a benchmark rate. That currently is 4.99%. So you have to qualify based on that rate. The thinking is that there's a stress test, you're qualifying at a higher rate. If rates are higher when you're up for renewal, that you'll be able to handle it. So the new rules that are coming into place now are governing how conventional mortgages are qualified as well. So borrowers that have the 20% down were not previously impacted by that rule change that came into effect. It was just borrowers with less than 20%. And now conventional borrowers, which make up about 80% of the market right now, are going to have to qualify under those posted rules as well. At the rate that the conventional borrowers will qualify for is actually higher than the rate that a CMHC borrower would qualify for. So the CMHC borrowers, as I mentioned, are set to what the benchmark rate is at the 4.99%, which the government sets. Conventional borrowers have to qualify at whatever rate they're paying plus 2%. So a 5-year fixed rate, let's say it's 3.19% today, they'd have to qualify based on 5.19%. So they're actually qualifying a higher rate than someone that's putting 5% down.
So is there any incentive for someone to put 19.95% down?
You pay the CMHC premium is the problem, and they've increased the premiums as well. There's actually better rates for CMHC mortgages right now, quite a bit better. Like you could potentially get a 5-year fixed at around 2.79 if you're putting 5% down. But if you're putting more than 20% down, the rate that you're going to pay is 3.09, 3.19%, somewhere in that range. And the reason for that is banks used to insure all of their mortgages, so conventional and CMHC mortgages. They would basically pay the insurance premium for a conventional mortgage and behind the scenes basically insure it through CMHC. And then when they were selling those loans to investors, it was a guaranteed return. If there was a loss, CMHC would cover it. The way that mortgages can be insured now has changed. So conventional mortgages are, someone with 20% down is more risk to a bank than someone putting 5% down, because that 5% down has the CMHC mortgage insurance to cover it. So that's been the challenge explaining to a client who's putting 40% down and is well qualified that they're paying a higher rate than someone who barely qualifies for a $300,000 condo.
That could really break down, like, the government, like, that's what they're trying to do.
Absolutely, for sure.
The subprime type.
Yeah, absolutely. I mean, us as taxpayers, the burden does fall on us, right? So I think the stress test, I don't think it's the worst thing ever.
But it's going to happen. In practice.
It will for sure. It will for sure.
Can you still put, I'm like putting out a lot of private info here, so I hope this doesn't go on the internet. I bought like 4 years ago
Okay.
as a self-employed person in TV
Yeah.
and a nonprofit guy, my partner.
Yeah.
So we were not, like we went with Duca, we
Yeah.
were not great. We put 5% down and I used my first time home buyer.
Yeah.
And is that still a thing that can be done? Because a lot of my people are like film people and whatever.
Yeah.
They're like, we're never going to be able to afford
Yeah.
unless they can do that.
So it's usually 10% down for a self-employed person now, like if you're
Okay.
doing a self-employed program.
Yeah.
And really, that money should be from their own resources. It shouldn't be a gift.
And it
They're
could be
really,
like first time home buyer?
yeah, they can use,
They
yeah,
can still
yeah,
do
yeah,
that?
absolutely, absolutely.
Okay, but they would have to qualify.
The
Yeah,
banks
they
are going to
have
want to
stress
look at a
test.
bunch of information though. Like they're going to want to look, if someone's like qualifying under a self-employed stated income program, the bank's going to want to see that the gross income that the clients earn, it's going to support carrying the mortgage. So
Yeah.
Are there any cashback programs anymore?
they are, but you end up paying it through the rate. You pay a higher
Yeah,
rate,
yeah,
right?
you
So
get
yeah,
the
but yeah,
market.
you can get,
Used to
yeah.
be that you get a market.
You can't use a cashback for down payment anymore. You can borrow from a line of credit though. It's the same thing basically. Yeah.
Jason, is a first-time buyer still the same as it's always been? It used to be, when they first started that, it was you could never have owned a property anytime, any place in the
No,
world.
there's actually like a test through CRA's website that you can go through. And if you sold a house, I think 3 or 4 years, 5 years, yeah. Or if a partner has sold one 3 years previous, then you can qualify again to use your first-time home buyer plan. So
Okay, so if you haven't owned anything for
Yeah.
5 years,
that's correct. So that's through your RSP. Now, you won't qualify for the land transfer tax rebate if you've owned a house anywhere. That's like, a one-shot deal. But you can use your RSPs if you go through I always just send clients to the CRA website. There's like a little questionnaire that they fill out just to make sure. Or, check with her accountant as well.
okay.
Yeah.
I had heard there was some changes.
I had a time where a client co-signed, basically their parents were having some financial trouble, so they co-signed just to help them qualify for the mortgage. And they got removed like a year ago and we're buying a place. And because they were helping only to qualify, we actually were able to get them to use their first-time home buyer plan. And they actually still got the rebate on the land transfer taxes as well.
Wow.
Yeah.
I have a question. To be able to qualify for land transfer tax rebate,
Yeah.
so there are two, Toronto and
Municipal and provincial, yeah.
So one is $4,750.
3,725. One's 4,000. The provincial one is 4,000.
4,000, but it says up to 4,000.
Yeah.
So does it depend on individual? Why does it say up?
Based on the purchase price, like if the land transfer taxes were only $2,300, they're not going to give you $1,700 back on top of that. They'll just basically, you won't pay any land transfer
But if
taxes.
the house is like
I think it's up to around close to like 400,000. You wouldn't pay land transfer taxes. So yeah, you get
4,000 and the other one is
3725. So it's 7725 is the total rebate that you got.
I think they're harmonized, they're the same amount.
But those rules.
Oh yeah, it is 8,000. That's right. Sorry, it is. Yeah, yeah, it's 4,000 and 4,000. That's right. Yeah, they changed that. Yeah. You should be a mortgage broker.
Are those rules here to stay or is there a time limit or now?
I don't see them changing anytime soon. And if I think, something does happen to the market, they're not going to loosen the rules. I think, I think the reality is that, they want to make sure that the banking system stays healthy and that people are, well qualified.
One more thing you did mention, so banks like people not having
that mortgage?
If someone puts 5 or 10% down, that mortgage gets approved through CMHC. The client pays the insurance premium,
Yeah.
and then the bank has a guarantee that if the client defaults on it, they're getting their money through CMHC. Whereas someone with 20% down, if there's a significant drop in house prices, that person could be, leaving them exposed, right?
Can that CMHC insurance be like put into the overall mortgage, or will that have to come out of their own resources?
It's always added into the mortgage.
Yeah.
So the only thing that you pay is you pay PST on the insurance premium at the time of closing. So you pay 8% sales tax on the premium itself. And that's made up, your closing costs are your land transfer taxes, the PST, and then the lawyer's costs. Those are the three things that you have to pay at the time of closing.
Perfect. So it's still sort of possible for self-employed people to get in.
Yeah,
Like, well, this is going to affect first-time home buyers, I heard, a lot more than,
a lot of first-time homebuyers don't have the 20% down unless they're getting help from the bank of mom and dad. In reality, I think maybe move-up buyers, people that were going from a condo that wanted to get into their first house. I think the reality is, if you're knocking, someone that would have qualified for, say, 850 and they're qualifying for 670, maybe it's going to be hard to find a house, right?
okay. Right.
Jason, how do you think it's going to affect the market?
I think what's going to happen is there's going to be a big run up for the next couple of months. It's going to be the exact opposite of what they want to have happen for the next couple of months. And then I think January 1st, I think we'll start to get a little bit of a lay of the land. But I can't, it has to change something, that's for sure. As I mentioned, a lot of borrowers, just the reality in Toronto at least, have to go up towards the high end of where their budget is. So if you're knocking like 20% off what someone qualifies for, it's going to have an impact for sure.
So are they concerned, do you think this is precipitated by what happened in 2008 kind of thing for the rest of the world, and we're just catching up now, or what?
Well, we've been pretty insulated from any real, shocks in the housing market. I think they're just being a little bit more prudent about things. I don't think it's the worst thing ever to have people qualify at this rate. The reality is that if you look back over the last 20 years, the average 5-year fixed rate is closer to 6% than it is, the 3%, plus or minus that we've been paying for the last 3 or 4 years, right? So I think a lot of people have become addicted to cheap credit, not just mortgages, but like credit cards and lines of credit and stuff like that.
I think it seems to be happening a lot over the last 10 to 15 years. People taking out a second mortgage on their properties to renovate their homes.
Yeah.
Instead of using cash to.
Or just paying out debt and then
Yeah,
3
paying
years
off
later
debt.
calling you to ask if they can
Yes.
refinance again. Yeah,
Yes, exactly.
Yeah.
And as realtors, we don't tend to see it as
Yeah.
much, but you
Yeah.
guys see it a lot, I'm sure. And so
Money's been so cheap as well, right? So people feel like, oh, let's do this and that, right? It's crazy.
So
Yeah.
that's why as listing agents, it's really, and fire agents too, but listing agents, it's important for us to understand how much is still owed on the house. Because sometimes they owe more than the value of the home.
You can't
And
collect
if you're
your,
selling a house,
Yeah.
you do not get paid. Exactly, there's no money to pay you if there's no money to come out of the sale. So you have to be really cautious of that. And
Or if
there's
someone's
any
really
concern-
sticky on a price and they won't
Yeah.
drop down, there's a reason potentially for it
Yes.
as well, right?
And
Yeah.
if there's any
Yeah.
concern too, I remember once we did the commission, so 5% plus HST to make sure all of that was as the deposit. Add your HST to it.
Yeah.
Make sure you're
Yeah.
getting the
You
full
mean on
amount.
the listing itself?
no, we take
Well,
deposit,
no,
we take
no,
deposit,
no,
we take deposit.
When you take a deposit, make
If
sure.
you're really concerned, you could always have, if you have a relationship with a lawyer, have them search the title on the house and they can show you what mortgage is registered on it.
Yep.
That's something that you could do.
$5 a
Sorry, I missed
Yeah.
that.
You could always have a lawyer potentially search the title on the house to see how much of a mortgage is registered. It won't give you the current balance, but we'll show you the last time there was a mortgage put on the house, how much it was registered for.
Yeah,
Yeah.
yeah.
And if it's recent, then
Yeah. Might be a problem.
Or if you see multiple mortgages, like a first and a second mortgage, that person's
But
probably,
even if you take that big deposit, they might not be able to close because you can't pay off the mortgage.
Yeah.
Here's that sometime.
Yeah, absolutely.
do you keep the deposit, like to go towards commissions, or would you potentially have to give it back if they were?
well,
Well, it's
if you
held
held
to
up
us.
before.
Yeah.
Yeah, so you're not getting paid, exactly.
When she bought it. Because Carolyn bought it.
The other change that came into that it was in the news for the OSFI rules was about bundling of mortgages. It will impact a very small percentage of the market. A lot of the alternative lenders, so like Equitable Trust and Home Trust, those kind of, if you want to call them B lenders, worked in hand with some private lenders. So because you couldn't go above 80%, they would basically do a first mortgage up to 75 or 80% and then get you a second mortgage up to 90%. And you'd pay like 15% on it. And the bank, the OSFI said that was a way to circumvent the down payment rules for qualification. So you won't be able to do that anymore. I've never done one, to be honest with you. It's a very small percentage of the market that would actually feel the impact of that. So I don't think that will have, any major, impact on the market. It's really the qualification that's going to be the big change for sure.
So the thing I'm starting to see more in the marketplace, and I think that with these new rule changes we'll see even more of, instead of a condition on financing per se, it's a condition on appraisal.
Mm-hmm.
And that buyers are looking to
Yeah.
actually make sure that they'll get a mortgage for it and appraise it, like it'll appraise it what they paid for it versus,
Yeah.
a traditional finance clause that we've used. So
It feels like you're kind of putting the ball, like if you think the house is worth that much, you should be, willing to grant us that appraisal clause. You know what I mean? And I found that appraisals over the last month or two have actually started to come back, at a decent level.
see it more, I feel like, as on the field.
I felt in September because of the, what happened May, June, that the appraisals were coming in short. Things seem to be a little bit better right now. Over the last month and a half, I've noticed that they've turned a corner a little bit.
Will that change in January though?
Potentially, yeah.
They probably have to take stuff now.
One of the things that we actually do for clients that are bidding on houses, if they have an MLS, they send it over to us and let us know the maximum price they're willing to pay. Then we contact our appraiser and they do like a desktop search just to see if the value is in line. They're not going to give us the exact value without going into the house, but if they send us a listing and say they're going to pay $900,000, if our appraiser sees comparables only at 8, they're going to let us know so that ahead of time before the clients put the offer in, they're aware that potentially might be an issue.
And remember, as either a listing agent or a buyer agent, we can be there when the appraiser is going to do the appraisal and show up with the comps in hand them to the appraiser and say, hey, I thought I'd save you a bit of time and help you out here. Here are the comps, and give them to them. They have access to look at all the sales, of course, and I'm sure they will do, but if you're guiding them and giving them the stuff, then they're going to likely use what you've given them.
And if you're an expert in the area and you've been in those houses and you can point out the differences, because they're only looking at, 4 little pictures this bit or 8 pictures on like MLS, right?
Yes.
They're not looking at things the way that you are. So that's absolutely right. We've had some appraisals increased and overturned.
Absolutely.
Yeah.
Yes.
Yeah.
Thanks, Jay.
All right. Thanks, guys.
Thanks, Jason.
Thank you. Thanks.